Okay, guys, welcome to this video. So in this video, we'll be talking about market structure. All right, I know that by now you might already seen videos where they talk about market structures as higher highs. All right, where we have this particular kind of structure, we have the higher lows, then the higher highs. Now, this is normally classified to be a bullish market structure, meaning the market is trending upwards, right? Then when you see the market creating lows, highs, then lower lows, lower highs, and lower lows, you tend to classify this as a bearish market structure. Now we'll have another structure which is the ranging form of markets, where the market trends to create relatively equal highs and lows. All right, this is termed a ranging market. So when the market is going sideways, there's no clear direction depending on the time frame you're looking at it. This is what is called the ranging market structure, ranging markets. Now this is the bullish, this is the bearish. So bullish here simply means that it is creating higher highs, meaning the market is going up, or the price of that commodity or the price of whatever pair you are looking at on the chart is actually on the uptrend. Now, the bearish here, this is what we call the bullish. All right. Now, I know this is already basic things you already know, but just stick to the end of this video because I'm going to um, give you an analogy that will help you understand why actually the market moves the way it does. So this is a ranging market. All right, so this is when the market is bullish, bearish, and ranging. Now, why exactly does the market not move in a straight line, or if the market is, it doesn't move in a straight line? Now, the reason behind this, all right, let me give you an example. Now, imagine yourself, all right, being a tomato trader. All right, now let's say the price of tomato as at today, right? Let's say this is the price, 2,500. All right, and you are planning to buy and sell for profits. Now, the basic aim of being a trader is for you to buy at a lower price and sell at a higher price. So you are um, aiming to buy a bag of tomato here worth 2,500, right? And you are aiming to, let's say, sell around 2,790. Now you buy at this level. Now once price gets to, because you're not the only one buying, all right, so a bunch of other traders that bought the bag of tomato at this particular price, which is 2,500. Then price gets to 2,009, 2,790 thereabouts, you guys start selling. Now automatically as you start selling, the value will now have a lot of supply in the market, so the price definitely, respecting the law of economics, so the law of supply and demand, the price will start going down. So you see that the price of tomato now starts going down. Now, because you are a trader, you are an active trader of tomato, you made profits, all right? So the price goes down from 2,700 down to 2,600. Now you've made profits of roughly 400, all right? So you now have 400 as profit. Now you want to buy you want to buy cheap again, and you want to also sell high again, then you buy at this level. So this area, you place another order, or order for another bag of tomato around 2,625. Then the price starts going up again because people start buying because they want to make another profit. All right, price is okay around 2,700, but this time around let's sell around 2,900. So you decide to sell at this area. Let me just pull this out. You decide to sell at this area. Then when you guys start selling, right, the price start dropping again. The price start dropping again. Then you decide to buy again cheap. Remember, you are making profits because you are buying low and selling high. So now the price goes up all the way to this level. Now you can see that every single time you and your trader friends, so to say, buys, the market push. When you sell, the market price of the bag of tomato retraces. As you can see, you buy again, then push the price up. You sell, the price goes down. Now, in the highest, looking at everything from the higher scale of time, all right, let's say within 3 months of that three transactions you guys made, you will see that the price of tomato has risen all the way from 2,500 to 2,000 or to 3,000 or 3,000, whatever currency you want to use it for. So this is basically what causes the markets to create the what we call market structure. So market structure is just simply a reflection of the behavior of traders in that particular asset. So when you see that a market price is going up, creating highs, lows, then creating higher highs, then higher lows, it simply means that the price of that commodity is in an uptrend. So now understanding where the market is going is actually the key thing to making money in trading. Because let's say, for example, you that is buying this particular tomato, all right, you guys have the larger amounts of the money needed to push the price of tomato. Now there are other small traders, you guys buy in bags, right? I'm trying to make you understand how market structure actually works and why you as a retail trader need to trade in favor of the trend instead of trading against the trend, unless you have some other information on the market. So but on the larger scale of things, you need to follow the trend. So if the market is bullish, you want to be looking for buy opportunities, because you as a retail trader, you are like a tomato seller that just have a small kiosk where you put like 200 pieces of tomato, you divide them into different volume, then you buy and you sell. Now there are other larger traders, which is the guys that are pushing this market, that are buying tomato in bags. They are the one that have enough money to decide if there's going to be scarcity or if there's going to be a lot of supply in the market. All right, so they are the one pushing the market, right? You just needs to follow the trend. Now you as a retail trader, how do you know the trend of the market, to know if you should be selling or if you have to be buying? All right, it is by looking at the market structure and knowing that okay, the market is actually in an uptrend, so I need to be investing or buying tomato at this particular point in time. So understanding market structure of anything you are trading, before you do anything, before you take any decision in the market, whether you want to buy or you want to sell, you need to know where the market is heading to. And also, if the market is ranging, you need to know, okay, this is when I should sell out of the market, or if I have a particular strategy, all right, that suits or that I can use in the ranging market, I'll use them. But you need to understand the direction of the market. So it is very, very important. Now, there are other elements of a market structure. Now, I'm going to be using the bullish structure. So we have the origin of the structure, have this, have this, have this. So this area is normally referred to as the low. So this is normally referred to as the low. Now this is the low. We're talking about bullish structure now. And this area, this is a high. After the origin comes the high, then the low. Then this is also a high, but this is referred to as a higher high. Now the reason why this is called a high high is because there's a high or a swing high below it. So it is a higher high, meaning it is higher than this particular swing high over here. Now, this retracement down here is referred to as a low also. But in this case, because it has a low, a swing low that is below it, is referred to as a higher low. So that's where the higher low you normally hear from forex mentors come into play. So we have the origin here, we have the high. The very first swing is the high. The very first swing low is the low. Then the next high is a higher high. Then this becomes a higher low. Now it keeps going on and on and on. Now this might not be that smooth on a real chart. I'm also going to be using a real chart example. You just need to get the whole concept. So as you can see over here, it keeps going on and on. Now here we still have another higher low. Now you're not going to say that is a highest low because there's no highest low in the market. That's one thing you should also take away from this course. There is no such thing as a highest low in the market. No market has a bottom or a top. That is why we have what we call all-time low, all-time high. All-time low simply means that since the beginning of this market, this is the lowest price it has been. And all-time high simply means since the beginning of this particular market, this is how far it has gone. That doesn't mean that it cannot exit that high. It will always There will always be time, all right, when it exits. Like take Bitcoin for example. Bitcoin in the previous bull run was 60K. That was the highest high. Now you won't say that is a high. That was the all-time high. Now you say that's the highest high because now in this particular cycle, Bitcoin is already above 100K. So telling you that there can never be a highest high. So you never see a market structure where someone will tell you that this is a high, this is a higher high, and this is a highest high. No, it's always going to be a higher high. The only thing you can say is okay, this is an all-time high. All right. So when marking your levels, this continues to be a higher high, this continues to be a higher low. Now, inside this particular structure, every single swing that breaks a new high, that swing creates what we call a breakout structure. Now, when it goes up again, it creates a breakout structure. Breakout simply means that price took out or has taken out the recent high and created a new high over here. So that's what you call your BOS. So BOS simply means breakout structure. BOS. Now there's what we call change of character, but I'm going to be explaining that shortly. So as you can see, this is what a bullish structure looks like. Now if you flip it upside down, it becomes a bearish form. So this becomes the origin. This becomes the origin. Comes a high. This lower low, lower high. Now if you are to flip it, this is the origin, this is a low. Now we are trending downwards. So this becomes a low. The very first swing down from a bullish structure after the origin here is the low. So this becomes a high. You can see that it's just opposite of what happened over here. Then this now becomes a lower low. And again, there is no such thing as lowest low in the market. You can only have all-time low, not lowest low. So this becomes a lower high. Now it can continue to go on and on and on. So this becomes another lower low, and this becomes another lower high. Now inside this particular structure, you see that each time the market creates a new low, which is a lower low over here, it automatically creates a BOS, breakout structure. Now when you see a breakout structure, you automatically know that okay, the market wants to continue downwards. So there is a breakout structure. This is also a breakout structure. Now in a ranging market, there are no breakout structure, there are no lower low or lower high. What we actually have is what we call relative equal lows or equal highs. Now that doesn't necessarily mean that it is equal. That's why they are called relative. So over here you have something like this, then might have something like this. You might even see price doing something like this again. Like the price is just moving within the same range for some time. So sometimes you have, like I said, they are not necessarily equal, but looking at this, you will know that they are not actually pointing towards a specific direction. So this is what a ranging market looks like in terms of there's no breakout structure change of character. This is basically we'll have equal highs, equal lows within the same range. Now, at the point where the market changes from bullish markets to bearish markets is what something happens in at that point, and we refer to it as change of character. Then we also have shifts in market structure. I'm also going to be explaining the difference between the two of them in the next video.